Hello everyone, you're very welcome back to the channel. Today we're talking about the following headline that was in the Irish Independent on Sunday morning. Crippling 41% exit tax on funds to be reviewed, says Finance Minister Michael McGrath. You might remember back in my Budget 2023 review video, I highlighted that Pascal Donoghue had mentioned that a working group would be established to assess the taxation of funds and investment products, which could potentially mean a change to how ETFs are taxed in Ireland. This headline in The Independent suggests that Michael McGrath, as the new Minister for Finance, intends to follow through on that working group. This news story quickly made its way into Irish personal finance Discord servers and WhatsApp groups, as well as my own personal DMs. Needless to say, Irish investors are pretty excited at the prospect of a change to the taxation of ETFs. However, it's important to manage expectations here. I know many investors are expecting the taxation of ETFs to be brought in line with the taxation of stocks. While such a decision would certainly be beneficial for Irish investors, it would also have implications for the Exchequer. And when you consider the context as to why this working group is being formed in the first place, it becomes somewhat less likely that ETFs will be brought in line with stocks without any counteracting measures to recoup lost revenue. So in this video, I want to share some changes that I would like to see made to the taxation of ETFs. To get there, we'll first briefly recap on how ETF investments are taxed for Irish tax resident investors. Then we'll talk about why the current ETF tax regime is how it is, and we'll highlight the context behind the formation of the working group. Finally, I'll talk about the changes that I'd like to see made to the taxation of ETFs in Ireland. All sections of this video will be timestamped for your convenience. Let me know in the comment section what changes you'd like to see made to the taxation of ETFs in Ireland and why. Let's start off with a brief recap of how ETFs are taxed in Ireland. Irish tax residents are liable to tax at a rate of 41% on gains made from the sale of ETF investments. Irish tax residents are also liable to tax at a rate of 41% on income earned from holding ETF investments. For example, if you invested in an Irish domiciled S&P 500 ETF, any dividends you receive from the ETF will be taxed at 41%, and any gains you make upon the eventual sale of the ETF would also be taxed at 41%. From a capital gains perspective, ETF taxation is unfavorable for Irish investors, given that the rate of capital gains tax applicable to most investments, including company stocks, is 33%. So for every €100 gain in an ETF, €41 goes to tax, whereas for every €100 gain in a company stock, €33 goes to tax. In other words, you're paying 24% more tax on ETF gains as compared to gains made on company stocks. From an income perspective, ETF taxation is actually favorable for Irish investors, specifically those investors who are also higher rate taxpayers. This is because dividends received from owning a company stock would be liable to marginal rate income tax, USC and PRSI. Given how early taxpayers enter the higher tax brackets in Ireland, for most investors, tax will be paid on any dividends received at a rate of either 48.5 or 52%. However, dividends received from ETFs are liable to tax at a flat rate of 41%. USC and PRSI do not apply. So as a higher rate taxpayer, you could be paying between 15 and 21% less tax on dividends by investing in ETFs. However, as a standard rate taxpayer, you could be paying between 54 or 57% more tax on dividends by investing in ETFs, which creates a large inequity between higher rate and standard rate taxpayers. The most well-known aspect of ETF taxation in Ireland is the existence of the deemed disposal rule. In effect, on the 8th anniversary of the purchase of shares in an ETF, if the shares have not been sold and if the value of the shares exceeds the price originally paid, then the investor will be deemed to have sold and immediately repurchased the shares on that date, thereby giving rise to a charge to 41% tax. This happens every 8 years. In other words, unrealized gains on ETF shares are taxed on the 8th anniversary of their purchase and every 8th anniversary thereafter. Unlike ETFs, unrealized gains on company stocks are only liable to capital gains tax when they become realized by virtue of the investor selling his or her shares. It's also worthwhile noting that losses on ETFs are ring-fenced. What this means is that if you lose money on an ETF investment, that loss can't be used to reduce your taxable gains on other investments. Whereas in the case of company stocks, losses can be used to offset realized gains on other investments. Finally, Irish tax resident investors are required to disclose their purchases of ETF shares in their tax returns. It's important to ask the question, why are the Irish tax rules for ETFs different to company stocks? There has to be a reason why they're treated differently, given that they're both exchange-traded investment products. The answer lies in what ETFs actually are. An ETF is a type of collective investment scheme. Collective investment schemes in Ireland are taxed under what's known as the gross roll-up regime. The simplest explanation of the gross roll-up regime is as follows. The Irish tax law allows collective investment schemes like Irish domiciled ETFs to earn tax-free investment returns. In other words, when the ETF realizes capital gains and receives investment income from its underlying investments, the fund pays zero tax. The logic here is that if the government were to tax ETFs on their capital gains and investment income, there would be a double charge to taxation. This is best visualized by thinking of a dividend payment. Let's say an Irish domiciled S&P 500 ETF receives €1 million worth of gross dividends from the underlying S&P 500 companies which the ETF owns. The US companies will withhold €150,000 of this payment as US dividend withholding tax, provided the ETF is a physical ETF and not a synthetic ETF. So the net dividend received by the fund will be €850,000. Now, let's say the government was to take €200,000 of this dividend as tax. The ETF will be left with €650,000. What would happen if the ETF then paid this €650,000 out to the ETF investors as a dividend? The investors would also be taxed. So a dividend that has already been taxed at the ETF level will be taxed again at the investor level. The same income is being taxed twice. To prevent this double taxation from happening and to make collective investment schemes more attractive, tax is only collected at the investor level. That is the most important point to understand. As a side note, many Irish investors fail to recognize how valuable the gross roll-up regime actually is. If you invest in a distributing ETF which pays out dividends, you're only paying tax at 41%, which is lower than what most investors would be paying if they receive dividends directly from the underlying stocks. Plus, because Irish domiciled ETFs aren't required to charge dividend withholding tax, you receive the full value of your dividend up front, which wouldn't be the case with dividend paying stocks. This gives the ETF investor an upfront cash flow advantage. If you invest in an accumulating ETF which reinvests dividends, you skip having to pay tax on the dividend altogether. This means that the full value of your dividend is reinvested by the ETF and is permitted to grow tax-free for 8 years until the deemed disposal charge arises. By comparison, UK tax law states that ETF investors have to pay tax on ETF dividends irrespective as to whether or not they're distributed or accumulated. That brings us onto why the deemed disposal rule was introduced in the first place, because it didn't always exist. When the gross roll-up regime was first introduced in 2001, the rules stated that tax would only be owed by an investor when they sold their investment. By utilizing accumulating funds, long-term investors would never have to pay tax on dividends that accrued in their name. The fund would simply reinvest the dividends and no tax would be paid. The long-term investor would also avoid having to pay capital gains tax because the fund holds the investments and thus is the beneficiary of any gains, but the fund doesn't pay tax. Therefore, any gains realized by the ETF could be reinvested tax-free for the investor's benefit. The only time the investor would ever have to pay tax would be when they eventually sold their investment. but for long-term investors, they could hold off selling for 20, 30, or even 40 years. So revenue would have to go that entire time without ever receiving a cent of tax from either the investor or the fund. To prevent this from happening, the government introduced the deemed disposal rule, and the rest is history. So why is there a call for change now? It mainly has to do with a report published by the Commission on Taxation and Welfare entitled Foundations for the Future. This is a 500-page report assessing the Irish taxation system and its sustainability. The report contains numerous recommendations by the Commission which the government can take on board when designing tax policies going forward. One such recommendation concerns the taxation of investments, and it's best if I just read the excerpt to you. Calls have been made for the tax regime for investments to be simplified in order to increase certainty, reduce the risk of error, and support tax compliance. Furthermore, while public debate has historically focused on tax rate differentials across products, i.e. 41% for ETFs versus 33% for stocks, this has broadened to a discussion on the neutrality of the taxation system with respect to the form of savings or investments chosen. Differences in tax treatment can potentially lead to distortionary behavior, with investors choosing between equivalent investments based on the tax treatment rather than on the investment outcome. I see this all the time. Many Irish investors will discard all of the benefits of ETF investing in favor of individual stocks just because the tax rate is higher. What they fail to understand is that they're assuming that their investment results with individual stocks will be, at a minimum, on par with the return associated with ETFs over the same investment period. This, as we know, is highly unlikely, especially over longer time periods. The Commission recommends the establishment of a working group to examine and make recommendations for modernising the taxation and administration of investments. This working group should include officials from Revenue and the Department of Finance, and should consult with relevant experts and stakeholders in the industry. Hence why Pascal Donoghue first mentioned the working group in Budget 2023, and why Michael McGrath is now emphasising his commitment to it. It all stemmed from this report. The main goals or guiding principles forming the basis of the working group should be A. How to simplify the tax treatment of investment products generally to give greater certainty to taxpayers, reduce the administrative burden, reduce the risk of error, and support tax compliance. And B. Identification of opportunities for greater promotion of horizontal equity and neutrality in the taxation system when it comes to investment decisions. This is a large undertaking, and it is essential that appropriate time and resources are allocated to the working group to achieve this outcome. The recommendation concludes with what is, in my opinion, the most important line to be considered when speculating on future ETF tax changes. The recommendations should also have regard to fiscal sustainability and be net revenue raising, or at least revenue neutral in terms of their impact on the exchequer. In other words, any changes that are made should either generate more tax revenue or, at a minimum, the same amount of tax revenue that was generated under the old policies. With all of that in mind, here are the changes that I'd like to see made. Number one, a reduction in the inequities between Irish tax resident investors and foreign investors. As things currently stand, investing in Irish domiciled ETFs is much more attractive to foreign investors than it is to Irish tax resident investors. This is inequitable. Foreign investors aren't liable to deemed disposal taxation. As such, they can invest in Irish domiciled accumulating ETFs and enjoy decades of tax-free growth. Irish investors, on the other hand, have to account for tax on unrealized gains every 8 years. The government might argue the point that because the investor receives a tax credit for deemed disposal tax paid, when they do eventually sell their shares in the future, the net tax paid will be the same as if they had only paid tax at the point of sale. I would disagree, because a euro paid today is worth more than a euro paid in the future. That brings me on to number two, a removal of deemed disposal tax. Don't get me wrong, I fully understand the rationale behind the original decision to introduce the deemed disposal rule. Revenue wanted to increase the rate of frequency at which they were receiving tax revenues from the investor, and they wanted to avoid a scenario where an Irish investor could avoid paying tax indefinitely. Because remember, the gross roll-up regime exists on the condition that tax is collected from the investor. However, this rule was introduced in 2006, 17 years years ago. It's an antiquated policy which was born at the height of the Celtic Tiger, and it doesn't have a place in modern investing culture. Here are but 5 reasons why deemed disposal tax needs to be reconsidered. The first reason is that globally, ETFs have become a staple of every investor's portfolio, and rightfully so. The data has proven that investing consistently in low-cost, passively managed index fund ETFs is the best way to invest for the long term. Online brokers like DeGiro, BookZero, Trade Republic, and Trading 212 are allowing Irish investors to invest in these ETFs with little to no brokerage costs. Plus, with the advent of fractional share investing, it's now possible to invest in these ETFs for as little as €1. There has never been a better time in modern history to be an investor than right now, but deemed disposal is holding Irish investors back. The second reason is that the deemed disposal rule requires Irish investors to choose between 2 options. Neither of these options are favourable for investment outcomes. Option 1 is to have cash set aside to cover the cost of deemed disposal tax liabilities. There's an opportunity cost associated with this. The cash could have been used to make further investments, but instead the investor has to account for tax on unrealized gains. Option 2 is to sell some of the ETF holdings in order to cover the cost of deemed disposal tax liabilities. Again, there's an opportunity cost. By selling a portion of the ETF investment, the investor is foregoing the additional gains or losses that would have accrued to the investor had the holdings been kept. The third reason is that the deemed disposal rule most definitely causes distortionary behavior among investors. It's hard enough as it is for a beginner to get to grips with investing, but when that beginner sees the minefield of tax rules around ETF investing in Ireland, it's a total put-off, especially considering the fact that ETFs themselves are globally marketed as being beginner-friendly products. As a result, that prospective investor will either A, give up entirely and elect to keep all of their money in the bank, which is a disastrous outcome, or B, attempt to invest in individual company stocks, which could result in an even more disastrous outcome. For a country faced with such a stark retirement crisis, I fail to understand why we're punishing investors for utilizing the most proven products for wealth accumulation. The fourth reason is that ETFs make for bad estate planning. Even death can't save you from the deemed disposal tax. Say an individual invests 100 grand into an ETF. 6 years later, that investment is worth 300 grand and the individual dies. The individual specifies in their will that his or her investments are to be left to his or her only child. As such, at the date of death, the gain of 200 grand will be taxed at 41%, resulting in a tax liability of €82,000. That tax liability of 82 grand will have to be paid from the estate one way or another. The child may receive the full 300 grand worth of shares at the cost of a lower estate value for other dependents, or the child may receive a lower number of shares if some of the shares are sold to cover the tax liability. In either case, the existence of a deemed disposal on death complicates tax planning. This isn't the case for regular stock investments. And the fifth reason is that the administrative burden of deemed disposal taxation is too heavy on the modern day investor. The vast majority of ETF investors in 2023 use some form of a euro cost averaging investment strategy. In other words, most investors are buying shares in ETFs every single month. From a tax administration perspective, this means that the average ETF investor employing a euro cost averaging investment strategy will have a deemed disposal tax liability every single year after the first 8-year anniversary. This has a distortionary effect on investor behavior because it inherently encourages lump sum investing over euro cost averaging, given that lump sum investing will result in a more straightforward tax administration exercise. However, the investor's decision between lump sum investing and euro cost averaging should be made on the basis of unique personal circumstances and desired investment outcomes, not taxation. I understand that without deemed disposal, the government's concern is that taxation won't be collected from investors. However, I think this concern is blown out of proportion. Most investors who are investing in ETFs are doing so for the purposes of wealth accumulation over multiple decades. The intention, more often than not, is to live off of this wealth in retirement in addition to any pension provisions that the individual may have. It's at this point that tax would be collected, just like it would with other forms of unrealized gains. Yes, the individual could pass away before they sell their assets, and in the absence of deemed disposal, those assets could pass to the next generation tax-free. But is that really a bad thing? We are faced with an unprecedented retirement crisis, and the promotion of individual wealth accumulation should be a top priority for the government. Yes, it could be decades before the Exchequer sees tax revenues, but at least your citizens will be accumulating wealth in one of the most data-proven and cost-effective ways possible. The third change that I'd like to see made is for 33% capital gains tax to apply to ETF gains, and for marginal rate income taxes USC and PRSI to apply to ETF dividends. This will result in a simplification of the taxation of investments, which was recommended by the Commission. The Exchequer will receive less tax revenue from every €100 of ETF gains, but more tax revenue from every €100 of ETF dividends earned by a higher rate taxpayer. However, keeping in mind that any changes made need to be at least revenue neutral, consider the following 2 points. Firstly, by reducing the rate of gains tax on ETFs from 41% to 33%, there's an argument to be made that more people will start investing. This could result in larger net tax revenues for the Exchequer over the long term. This is especially true when you consider that an individual's capital is much more valuable to the Exchequer when it's invested as compared to being left on deposit in a bank account. Why? Because deposit interest rates are abysmal, which by proxy means the tax take from deposit interest retention tax is also abysmal. Contrast this to the equity markets, which have returned on average about 10% annually over the past century. The Exchequer will participate in this appreciation to the extent that taxable persons participate in the equity markets. Secondly, I suggest that all dividends accruing in the name of ETF investors should be taxable, irrespective as to whether or not the ETF is accumulating or distributing. The primary benefit of accumulating ETFs to investors should not be the avoidance of tax on dividends. This is inequitable when compared to the tax treatment of investors who own the underlying dividend-paying stocks directly. The primary benefits of accumulating ETFs should be convenience and the avoidance of additional brokerage costs. This policy change would likely result in a significant additional annual tax take for the Exchequer, especially when paired with the application of marginal rate income taxes USC and PRSI to ETF dividends. A big part of the reason why deemed disposal exists in the first place is because of reinvested dividends. So let's just tax the dividends and get rid of deemed disposal. And just to be clear, I'm not suggesting that dividend withholding tax should be introduced at the fund level. I'm solely talking about taxing dividends at the investor level, irrespective as to whether or not the fund is distributing or accumulating. This change would mitigate the government's concerns that taxation won't be collected from investors. Given that most index-linked products have some form of dividend yield, the Exchequer will be collecting tax revenues on an annual basis. This also simplifies the tax reporting requirements of investors, given that they'd only have to include their annual ETF dividend income on their tax return, which is easily accessible information. Compare this to the process of calculating deemed disposal tax liabilities every year on different ETF purchases, in addition to declaring any dividends received from those ETFs. Granted, I do accept that for ETFs with no dividend yield, the Exchequer could still be waiting decades to collect tax revenues, but that's on unrealized gains, not reinvested income, which is a globally accepted principle of taxation. If this really was an issue, which I don't believe it is, you could make the case for solely allowing mainstream index-linked products to avail of the aforementioned treatment. However, that in itself would create additional inequities. The fourth change that I'd like to see introduced is the removal of the ring fencing of ETF losses and the extension of the annual CGT exemption of €1,270 to ETF gains. If an investor makes a loss on ETF investments, that loss should be allowable against other investment gains, including ETF gains. Ring fencing ETF losses creates inequities and it encourages distortionary behavior. It also doesn't capture the true economic position of the investor, i.e. whether or not he or she has made a net gain or net loss on investments. The government allows losses on REITs, which are another form of collective investment product, to be used against investment gains, so why not ETFs? Granted, REITs are required to distribute 85% of their income annually to shareholders by way of a dividend, thereby ensuring the collection of annual tax revenues. However, with my proposed changes to ETF dividend taxation in mind, it makes sense to permit ETF losses to be utilized. As for the annual CGT IGT exemption, it just makes sense for this to apply to ETF gains if those gains are to be taxed at 33%. Here's the last point I want to make. In order for progress to be made, there could very well be a need for the government to deal with the taxation of ETFs separately to the taxation of other collective investment schemes. ETFs are very different in terms of how they operate as compared to the likes of mutual funds and life assurance products, which would have been the prevalent collective investment structures at the time the gross roll-up regime and deemed disposal rules were introduced. ETFs inherently generate less capital gains than mutual funds due to the way that ETF shares are created and redeemed. Furthermore, index funds as a whole generate less taxable capital gains than actively managed funds. The point here is that when it comes to index fund ETFs, the exchequer isn't necessarily missing out on as much tax revenue by foregoing a tax on capital gains at the fund level as they are for other collective investment products. Therefore, it's not appropriate to consider all collective investment schemes as being equal in terms of tax potential, and that should be reflected in tax policy. That's my take on ETF tax policy in Ireland. Let me know what your thoughts are in the comment section. If you're thinking of buying a house in Ireland anytime in the next 12 months, you might be interested in this next video. Thanks very much for watching, and I'll see you soon.